What's up, outliers? Happy Friday. Today, we are following up on the session from last week. And the goal here is for us to walk through actual corrective actions for the brainstorming that we did. And really, our brainstorming last week was kind of cool because all the stuff that we identified here were actually based on live examples. So we went through Reddit and we poked through and said, hey, like, what are the most common things that we're finding here related to what we think options traders are making bad decisions on? Where are we going wrong? That's the goal. Now, quick question as we get started. First, is the mic coming through too loud? I can't tell on my end because I don't hear anything. I literally just hear myself talking in my office, but the little bar looks like it's going crazy. That's the technical term, I'm sure. So I just want to make sure I'm not blasting your guys' ears out. Okay, cool. Thank you, guys. So we purposely broke out the general quote unquote issues we identified into knowledge, process, and behavior. Now, the reason is I think it's easier to approach and address problems if they're segmented, if we can generally categorize stuff because there are going to be synergies in between these different topics. So the way I want today to work is I literally want to walk through literally all of these and discuss, at least at a high level, what steps a trader would take in order to address the issue listed. Then what I would love to do is if there are any that we go through that you're like, I want to double click into that, or you're curious other ways to address it, please tell me. And then we can spend a little more time on a handful of these, but I do want to get through all of them. So my plan is to go through with a high level pass up front. So with all that aside, I was actually talking with my buddy Joe last night. A lot of you guys know him. He did a couple episodes super early on in like the very, very early days of the channel. It's actually really fun. And he and I were talking a little bit about trading and just business and stuff. And one of the things we were talking about last night is the propensity, in my opinion, for the overwhelming majority, specifically of options traders, that start this entire process literally entirely backwards. Almost everybody starts the process of trading options entirely backwards. What do I mean by that? A lot of you that have been around the community for a while now will have actually a pretty good sense of what I'm getting at with that. But for a lot of people, as you go through, again, a place like Reddit, we could do it again really quick and just see what's on there. I'll sort it by new stuff this time and see how many new instances have come out on the literal same topic that we look at pretty regularly. So let's grab our friend Reddit. And I'm just going to sort this by new, right? So the stuff that's definitely come out in the time frame that we've started doing these. This one is talking about cheap options trading, which is cool. Let's see. Let's start with 0DTE strategy feedback. It has no upvotes, so I think we're stepping into something gold. I wouldn't say I have an edge at all. 0DTE strategy, incredibly successful. Trying to trade mini reversal, and I start buying calls when SPY is tanking or when SPY is spiking. I'm super conservative with how I buy them. This is essentially how they're buying them. High success rate, current method, but curious if anyone has any thoughts. I have to be completely honest. This is not as bad as I thought it was going to be. Literally. This is definitely not as bad as I was expecting. The main reason for that is they're at least basing this on something, right? They're saying like, hey, I'm trying to trade this thing. So that's literally not bad. Now, the rest of the details, obviously, we could always dig into that. But for the example that I'm looking for, that one actually passes the test, meaning they're not just doing what I imagine most do. Let's see. Should I let credit spreads expire in the money or close before 4 p.m.? I have a Carvana call spreads in the money, hoping price comes down. From my understanding of the short leg, that's kind of not the same thing either that I'm looking for. Anyways, I'm not seeing anything jumping out at me. Oh, this one's actually probably interesting. Finally starting to understand options. This is great. Let's see what they're learning. Year of trial and error, starting to understand how to properly use options. This is great. So they've stopped YOLOing. That's pretty basic. Selling cash secured put stocks on. Yes, this is a great example. Selling cash secured puts on stocks I'm happy to own. Owning covered calls on existing positions. Avoiding winning trades unless hedged. Keeping investments small. Entering only when risk reward on a plan are clear. This is literally perfect. This is a great example. So in this case, this is, again, somebody that I think demonstrates what most people do in options trading. And now that we've found a decent example that happened in literally the last 24 hours, let's deconstruct what's happening here. The main thing is, if we use this as a proxy for how people start trading options, and in this case, this is one that's actually been apparently at it for a year. What do we notice? We notice that all of these really are just structures. So for example, selling cash secured puts on stocks you want to own, that doesn't really mean anything. That's not an edge. That's not a way to make money long term. This is literally just a general option structure, and I would maybe call it in this context a basic strategy, because they do have some qualifying material around this, stocks that they're happy to own. So like maybe we call it a very basic strategy. But in that context, there's nothing here. This doesn't mean anything. Same thing, owning covered calls on existing positions. Like this, first of all, this is a fundamental misunderstanding of options. You don't own covered calls, but again, not getting sucked into picking apart everything I see in here, which, by the way, when I read these posts, this is what my brain does. I just see millions of things that tell me different things about the person posting. But in this case, the context of covered calls, selling covered calls on the positions that you gain entry on, that's not an edge. There's no edge in that. That's not an edge. So what I'm highlighting is most options traders start right here. They're focusing on structures. They're focusing on trivial details like DTE. They're focusing on strike, right? So they're focusing on these different pieces that in the greater context of things really don't matter. They really don't matter that much yet. And instead, what the overwhelming majority of traders need to focus on is market effects, and profit mechanisms. This is it. And the reality is, as we scroll through Reddit or these other places, and I'm sure you can take a look at your own experience, right? Like if you just keep it a buck with yourself, you probably will identify this same thing, because I'll tell you what, that's how I did it. And I don't think my approach or what I did is probably all too dissimilar to what most people did early on, which again, it just tends not to work very well long term. It's just the fact of the matter. And the reason for this is super simple. It's that people tend to think that there's some sort of magic in options, some sort of magic in option structures, that just by trading options that there is edge. And it's genuinely not the case. Options can absolutely create access to edge or help you to monetize or extract edge for sure. But there's nothing inherently baked into options trading that you get edge simply because you're trading options. And it's a super common misunderstanding. So let's get back to this. And we're talking about these different kinds of common mistakes. Now, what we're talking about, all of these different pieces that we're talking about right now, funny enough, really bubble into this bucket, knowledge. So let's talk about how we can straight up, line by line, address these. And it's not that difficult. And if you identify with any of these, you should be able to very clearly see a path through based on what we're about to cover. So this should be pretty dense, move through pretty quick. And then again, when we get through the list on the first pass, we'll circle back on the more important things, or if there's any that specifically apply to you that you want to spend a little more time on, I'm happy to do that. So not knowing what you don't know is really difficult to get around. And it's because ignorance is challenging. The easiest way to get around this is through consumption of information. Now, the tricky part is most people, and I find this a lot even when I'm working with people in like the Pro Plus workshops or in coaching sessions and stuff like that, where we're like really trying to solve problems, is a lot of times people are trying to solve a problem to get a direct output. And as weird as this sounds, a lot of what you do in trading is not that. A lot of what you do in trading is actually building context to help you understand things so that then you can make better questions, better problems for yourself to solve to get you closer to that end state. So here's what I mean. There's somebody that I've been chatting with for a little while that's working on like a short-term vol trading strategy, specifically 0DTE and SPX. And we're running a couple different studies. And one of the studies that we shaped out for the person, they were essentially saying like, okay, yeah, this makes sense. You know, we were talking about a next step to that study. And then they were like, oh, does this next step, you know, is this like worth my time? Should I do this? And I find the question fascinating because I totally understand the intent behind the question. But the funny thing is, at that stage, literally everything is worth your time. Everything. Why is everything worth your time? It's because of this. It's because at that point, we don't know what we don't know. And the only way that you're going to build a rounded, comprehensive understanding of trading in general and then trading options is just diving in and doing a bunch of analysis on a bunch of things, even if you finish running a study and there's not a direct output that makes you money. And again, this past week, there was a perfect example of that. They had ran a study comparing a couple different vol products to try to potentially use as a signal or a filter for their strategy. Great idea. They finished going through that process and then they did a correlation test, right? They wanted a feature match. Is there some sort of predictive value of this vol relationship ratio that was set up and profitability? And there wasn't anything, unfortunately. But their initial reaction was that, right? That this is unfortunate. But from the trader's lens, it's really not unfortunate. This is just another data point that now we understand much more deeply the relationship of long-term vol to short-term vol to our intraday trading strategies and how that impacts stuff. What do we find out? That maybe that relationship does or doesn't impact things the way that we thought it might. And then that gives us the perfect jump off point for the next step of analysis. So the point I'm making here is actually quite the opposite. A lot of the research you'll do in trading realistically is going to lead you to null. It's going to lead you to a null hypothesis. It's going to lead you to something that doesn't tell you something direct or discrete about what you're researching, but that in and of itself is super informative because it's teaching you relationships. It's teaching you what features tend to matter in certain instances and not. And it's all in the greater purpose of eschewing obfuscation. You're learning the things that you don't know. So the way to address this very first one is literally try to study pretty much everything. Now, there has to be a balance, and I don't see it written in here specifically, so I'll cover it in this one as well, because when you're doing this and you're studying everything, you can get lost in the sauce, right? So the thing that I would pay attention to when you're studying everything is just to gain exposure to the topic. It's not to turn everything that you're seeing into some tradable idea. Again, that's what most traders are trying to do in those cases. They're trying to spend as little effort as they can to read the one thing that's going to give them all the money that they want, and they're not going to find it in the business. So what a good approach is in this context is, as you're reading through things, I wouldn't immediately start trying to operationalize it. If so, for example, if you read some sort of book that talks about a technical indicator, maybe you're talking about anchored VWAPs. Brian Shannon does a lot of stuff on that. I had him on the podcast fucking forever ago, and he really likes the anchored VWAP. So maybe you read a book about the anchored VWAP, and then you think that this is going to be the cure to your trading cancer, and as you're reading it, you're immediately trying to figure out how to operationalize it. That's a mistake. The reason why it's a mistake specifically for newer traders is you just have to see shit. You have to see shit and experience shit in order to build this context window. It's the same thing if you play sports. When you play sports, when you're younger, you tend to play a bunch of different positions because they don't know what you're going to be good at. They don't know what your attributes naturally lend you towards. So the way we figure that out is through trial and error. We do it by putting you in different spots. We're seeing, okay, that kid can't throw for shit, so they're not going to be there. Maybe they can catch the ball real good, right? So that's the experimentation process and really the inundation process. But the way that you get through this is you're trying to get exposure. You're not trying to turn everything you're seeing into some sort of tradable idea, into some sort of tradable filter. The reason is you'll get sucked up. And what I mean by that is, like, you'll learn about the anchored VWAP. You'll be so deep in anchored VWAP land trying to test everything about it to learn how to trade with it. And then you might find it literally just doesn't work for what you're trying to do. That's a massive time suck. So the way to be efficient about this is just get exposure in the beginning and then take notes of things, right? If you come across the anchored VWAP, to continue using the example, and you're like, this thing kind of makes sense to me. Then we shortlist that. That's something that we're going to come back to and we're going to spend more time on. But before I double click into the anchored VWAP, I'm going to go look at other shit. That's what I mean. The other thing, to give you a very specific thing you can do, is you can grab that book that I've shared before on market structure. Let me see if I can find it. This one. This is like an absolute awesome starting book. And I'm not affiliated with this dude, with this book at all. This isn't like some sort of plug. It's just something that I think provides a really great starting point for all traders to start addressing this topic of not knowing what you don't know. This kind of book introduces you to all of the participants, what they're trying to do, so that there's not a lot of these, secondary questions. Like when we were scrolling through Reddit just before, my eye caught one that was asking about, like, who are the market makers for UVXY? Like, if you read this book, you know the answer to that. So this gives a lot of general market context. And then you guys already know, with options, the book I recommend for that is Options as a Strategic Investment. And it's like, there's actually quite a few things in that book or with Larry's style that I don't actually fully agree with, but I think it's such a comprehensive first take on just about everything that it is a fantastic starting point. So this is how we address this. We address this simply summarizing everything that we've talked about by making sure we're calibrating that we're looking for exposure, we're looking for context. We're not looking to trade everything that we read. We know we need to understand the basics of stock market behavior, stock market operations. We need to know how exchanges work. Again, I'm talking about this from the professional lens. You can pick and choose which of these might be relative to you. But what I am saying is, if you were going to do this at a high level or to try and actually live off of it, This is the shit you have to do. You have to know this stuff because all of it informs the rest of the decision making that you come up with. So once we understand how markets work, we need to spend time doing a insane amount of research on options themselves. So this goes into fundamental gaps. Before anybody even starts worrying about how to make money from options, even what profit mechanisms are good to trade, like all of that stuff, in my opinion, is secondary at this point. You have to know how the tools work. And the fact of the matter is, like, most people don't. And there's something to be said, based on your learning profile. You can absolutely learn as you're starting to trade, but that's just ripe for losing money and making mistakes. So you have to figure out what's right for you and how much you're willing to spend, essentially making stupid mistakes that otherwise can be avoided. Most of my preference would be to paper trade for 3-6 months. And you'll see a lot in that. And you'll probably want to paper trade for a little bit longer afterwards because you realize like how many mistakes you'll make. And that's okay. We all make mistakes for the first while of trading. It's not even like the first 6 months. That's just to rough out the really bad shit. But you have to develop a deep understanding of how options behave in order to make good decisions. Now, one giant caveat that I did not mention for this that I think is important to note, the not knowing what you don't know, to go back to this one really quick, is this is really challenging, by the way. And I actually would leverage something like ChatGPT or AI, but this is really easy to spend a lot of time on shit that doesn't really matter. So a great example of that is if you go scrolling around X, you'll find a lot of, like institutional vol traders that are talking about, institutional impact of Charm and Vanna. And it's like, you can spend time learning about that. Again, for context, it's good. But what I can literally guarantee you is as a retail trader, that doesn't fucking matter that much. It just doesn't. The same thing when you see different kinds of conversations that are more theoretical or academic in nature, right? You'll see people talking about how should vol models adjust for weekend decay on Friday and then opening up on Monday, right? And again, it's like, that's nothing that's going to hurt you. It's okay to know that stuff, right? I spend time learning about all of it because it's interesting to me. But still, that's not the shit that's really going to do you any huge favors, especially when you're trying to learn how to trade. So the main note to keep in mind as we go through all of this is that there is a bit of a motherfucker when it comes to trying to differentiate between the shit that matters and the shit that doesn't. And it's always worth asking yourself the question of like, do I think this is something I can monetize? Do I think that this is something that, actually impacts what I'm doing? If so, that gets added to the short list. If you're looking at something and there's a debate between the way that market makers are going to update their surface models, again, okay to pay attention to that, but from the functional side of trading options, that's not super important up front. What's way more important than understanding the nuances of that is looking at market effects, looking at profit mechanisms, stuff like that. So to summarize, the knowledge side of stuff is as you're going through things, it's absolutely worth your time to test and explore just about everything. You have to be focused, but the way that I think about maintaining focus is by just clearly delineating short list from, future hits. So things that really need to be revisited or spend more time on, because I think there might be an immediate impact or near-term impact versus the longer-term stuff, right? Great example of that is building your own Black-Scholes Merton model. It's like, it's good to know, right? And I think from a fundamental understanding, that's something that is a little bit higher on the list, specifically because it gives you a sense of relationship of the pricing inputs. But that being said, there's other stuff still that would be ranked above that. So it's kind of doing things efficiently, but paying attention to the stuff that ultimately impacts your trading versus the stuff that doesn't. I do want to talk about overconfidence, underconfidence. So this is really easy to fix, by the way. Overconfidence is fixed by logging your trades. Underconfidence is fixed by logging your trades. That's pretty much it. If you log what you do and you objectively evaluate it, you're going to see things. Now, one thing to keep really, really close eyeballs on is the propensity for most new traders is to prematurely find yourself in overconfidence. And it's the propensity for more seasoned traders to find themselves in underconfidence. So if we go to my website, I have a resource that kind of helps talk about this a little bit here. And it's really called the Dunning-Kruger effect. So what ends up happening is as people learn the basics of things, our knowledge exponentially expands. So if we look on the y-axis here, how fast this person is gaining competence in a very short time frame, right? So this is the total growth in competence, but this is the total distance traveled, which really is not far at all, right? So we're gaining competence very, very fast. The problem is, as we're gaining this fundamental competence, a lot of times we confuse it with confidence. So confidence skyrockets because now we know some basic concept, basic terms. We know what Black-Scholes-Merton is. We know what implied vol is. Like we understand these fundamental things. This is typically where the peak occurs of skill gap and overconfidence shows its face. And this is typically where people are going to unwind a bunch of money and unwind a bunch of confidence until they end up at this point. This point is a natural point for just about everybody. I had this point. You will have this point. If you trade, you're going to have this point. We all have the point. The reason is because this is so hard to avoid that you almost can't. It's just going to occur in different phases and different levels. I truly believe most people can minimize the effect of this if they're really thoughtful about the way that they begin trading. It's just the reality is most people don't do that. So as you're gaining experience, the way that I would give you a Cliff Notes version on overconfidence, underconfidence is if you have less than 5 years of trading, you're new. You don't know stuff yet, and you don't have it figured out. I feel super confident in saying that. Within 5 years of trading, you don't have it figured out. And that's okay. You're not supposed to be some sort of expert in that window, right? 5 years is a while, but 5 years is a drop in the fucking bucket of something that hopefully you're doing literally for decades. Again, think of any other skill you've developed. There are not many skills that you get really, really, really good at in a short-term time frame. There's a lot of skills you can get marginally better at very quick. Again, we can all do that right here. This is where that happens. But in order to actually build proficiency and master the skill that you're learning, it takes time. And I give you an example, right? The 10,000 hours is commonly thrown around. Again, I'm not sure how efficacious that benchmark is specifically for options traders, but the main thing here is the context. If you spend 5 hours every day for 5.5 years, that gets you to that 10,000 hour handle of something. So what I'm telling you, and the reason why I give you this is for context. So if you're spending 10 hours a week learning how to trade, learning options, sitting down, reading, studying, that's great. That's really, really solid. But your duration to mastery is obviously going to take much longer. And I'm not saying, again, that the 10th, it's not like binary. It's not like if you're at 9,999 hours, you are not master, and then at 10,000, you're at master. That's not what this means. But this is a really good gauge for a general assessment of proficiency and when that's typically hit, like actual proficiency, mastery at something. So the thing that I would remind people to keep in the back of your brain is what's most important to you, I argue, in the beginning for traders, is avoiding overconfidence. And the reason for this is because overconfidence just gets really expensive. That's overconfidence is the exact scenario where, again, if we just scroll through Reddit really quick, I guarantee you that we will find tons and tons of stories about people in different levels of dismay. I'm just going to type in the word loss. And I'm going to sort it by new. And let's see. Am I wrong? Don't care. Yesterday, I broke my own trading rules, paid the price. So let's see how long. I don't see anything in here that talks about their experience, but still, again, really, really good starting points. Making 500 per week on 100,000. Am I likely to wipe out my account? This is fun. This is a post from me that got under everybody's skin on there. It was absolutely hilarious. I enjoyed that one. Let's add the word ruined. Here we go. Loss, broken, demoralized, and ashamed. Trading has ruined my... Oh, this one's a troll. That's actually funny. Let's see. Whole life spiraling, up over 8 grand, lost 11 in 20 days. Blah, 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 blah. What I'm trying to give you at least some sort of context on is how frequently that this exact thing occurs in terms of overconfidence. And it's very difficult to avoid. The way to avoid it, I think, is literally just implement a hard rule in your brain. Within 5 years of doing this, I really don't know much, and I'm learning, and that's okay. I'm excited to learn. There's a lot I can learn, and there's actually a lot you can do to positively impact your trading account in the 5-year time frame. It doesn't mean that you can't make money or that you can't grow the account within that 5-year time frame. That's not what it means at all. What I mean by adding that disclaimer in your brain is just to prevent you from too eagerly stepping further out, right? Because healthy caution is really important in the beginning. So that's in the context of somebody that sees something that might look too good to be true. And when they see it, they say either, oh, I'm skilled and it's because of me that I'm seeing this, and there's probably something really good here, and it's, just a result of my skill. But somebody that's more cautious will say something like, this looks really good. I don't trust it. And I don't trust my analysis of it. I think I'm missing something, right? Two completely different things. A great example of that is there's the trader that traded a box spread on UVXY. They thought that they were getting a risk-free return, which a long box spread can be depending on what you traded on. And they were going to make a bunch of money because UVXY is crazy volatile and it has assignment risk. So the box spread was priced to compensate for that risk. And they ended up getting assigned, lost a ton of money. The point I'm making there is that somebody that didn't have enough healthy skepticism about their own skills. So the last piece on that is, again, it's super easy to avoid. Just remind yourself, if I'm within 5 years, I really don't know anything. I need to second guess everything. And that's not a bad thing. From there, if you're paper trading that entire time, or if you're mix of paper trading and logging your real trades, you'll be able to see your performance. And that addresses this inherently. Underconfidence is super easily solved. there's no words of affirmation that fix this. There's nothing you can say to somebody, just be like, be more confident. That's not how it fucking works. The way you build confidence is through demonstration of a skill set consistently over time. That's what builds confidence. So if you think about something that you're supremely confident in, it's based on a clear understanding and track record of something. Whereas if you say like, oh, I just need to be more confident, that literally doesn't mean anything. It doesn't work. So the way that you address underconfidence is literally by demonstrating to yourself the skill. So this can be through paper trading. This can be through live trading, but minimal viable size. And once you develop enough of a track record where you start to say to yourself, like, yeah, I think I have a pretty good handle on this. The way to think about underconfidence is the time that you don't really think about it anymore is when it's solved. But I would definitely think for most people, it's better to err on the side of underconfidence than overconfidence in markets, just because overconfidence generally leads to very expensive mistakes. That's the only reason. In general, I actually have a bias for action and a bias for aggressiveness. So that I don't say that lightly. In general, I think it's better to be overconfident in most things so that you'll actually do it and then experience it, learn from it, grow, that whole stuff. But in trading, unfortunately, I understand the reality that most people that fall into one of those buckets, they don't have the disposable income to lose, right? So that's why in this context, I actually invert that general bias that I have because I think it's more practical. Let's talk about process. Process is really easy, by the way. Process, all you do is think about what you're trying to do and then build a framework for how you're going to do it, understanding that that framework is going to evolve and grow as you go, and start doing it. That's literally it. So the way that I would think about starting to build processes is like, think about the major muscle movements that need to happen for you to figure out this trading thing. The very first process you have to figure out is education. How do you intend to teach yourself or get taught or combine those two? It's entirely up to you. It's entirely up to your learning style. The one thing that I absolutely will say is I think there is more than enough information on the internet in order to teach yourself. I absolutely believe that. The problem is that's really, really difficult. So what I mean is it's, especially when you don't know what you don't know, you could start going down the route of binary options because you come across a post that's written beautifully on it that seems to make a lot of sense. And all of a sudden you're down this pretty gnarly path. That's one of the beautiful things, again, about our community, the Outlier community. It's free for everybody to join. You do have to go through the Patreon thing, and that's literally just to try to keep out the spammers. I just tried to change that this past week. I'll actually show you what happened after I got rid of it. But you have to join through the free side of the Patreon. It's still completely free to join. But after I started making it public again so people can more directly join, which really is my preference, this is literally what happened, which is hilarious. Because if I show you the context of like days prior, if we look at days prior, there's like, 1, 2 people that make their way in every once in a while, right? Pretty quiet. And then all of a sudden I changed it so that essentially you could just use the link, everybody can join, and take a look at what happens. We get an absolute download of spam accounts. When this happens, when the names are next to each other like this, it means they're joining essentially right on top of one another. So all the spam accounts just start flooding in. So anyways, that my aspirational idea to get rid of that isn't in a place yet, but still it's completely free. To get back to the point at hand, I do think it's good to be able to bounce stuff off of people. So in developing process, Starting with education, the easiest way to do this is mirror what we talked about in the beginning. I would set literal appointments with myself. I would say each day, every other day, whatever the duration is, and I would make an agreement with myself. I'm going to spend at least 15 minutes or at least 30 minutes, whatever it is, and I would treat it like an appointment. One of the things that doesn't work is when people say, oh, I'll spend an hour on it a week. And then most of you know, over the course of that week, there's a ton of things competing for that hour that if it's not carefully slotted in and guarded, it will literally just slide off, which is crazy. So, education, bam. After education, developing a process for your education, I would think about stuff like how to develop an edge. So that's like the outlier strategy process, how to find trades, how to test strategies, how to manage a portfolio. All of those deserve a process. So I would just think about like, what are the major muscle movements that have to happen in order for me to learn about portfolio management? How do I manage a portfolio? And I would just list out the major muscle movements and then literally build a process wrapped around it. Not all of these have to be super serious things, but they should be things that ideally will lead to something you can iterate over time. Because an important note here is the reality that most of the processes you build in the beginning are not going to be what you're going to do long term. They're going to change for sure. Now, Reese says, I had ChatGPT give feedback on why I was hesitant on certain trades because it's obvious and not creative, which are true. Oh, that's funny. Yeah, I think the reason, Reese, for something like that, when you're hesitant, is that you just don't have confidence in whatever the thing is that you're trying to execute, right? Like if you're confident in the strategy, then that goes away. That hesitation is gone. So that goes back to just how to build confidence. And you build confidence through the demonstration of the skill set. How do you demonstrate it? You can paper trade it. You can trade it in minimal viable size and log it. And then once you see enough occurrences where you can actually start plotting your results and you can start to see like, yeah, okay, based on the times that I've done this so far, I'm actually making more than I'm losing by a lot. I'm okay with that. I'll take that risk. That kind of thing. Hey, yo, what up, TCM? TCM says, have you on in the living room? That is a absolutely wild business decision to make. But my kids think you're boring, trying to train them young. How old are your kids, TCM? We'll see if we can find a piece to talk that's a little more relevant to them. Because, yeah, I mean, this shit undoubtedly would be boring. Unless, like, you're saying kids and they're not kids. Because if not, they just need to get introduced to the world. But 10 and 12, yeah, they're still young. I mean, TCM, the way you get them interested is next time that they want to buy something, just be like, okay, you pay for it. And then they're going to look at you and be like, dog, with what? And then you'd be like, aha, gotcha. Remember that stream we were watching the other time? That's how you figure that part out. So I don't know what kind of stuff that they like, but what I would tell them to try to get their interest is that having money is cool and having more is better. So this is how you get there. I love that though. That's fun. Let's talk about behavior. So the behavioral traps that exist for you in trading is absolutely insane. There's literally so many bad paths to go down. It's not even funny. So I want to just bubble most of these up because, again, it comes down to these two broad concepts. Building discipline is difficult, but it's completely doable. It just takes some time. The way that I try to work with people on building discipline is starting really, really low, right? Super low threshold, and then build it over time. There's literally a part of your brain that originally will provide resistance to discipline because discipline is generally done in the application of like doing something you don't really want to do. And you have to overcome that friction. So the lower you make the friction that you have to overcome, the easier it is to actually execute discipline in that instance. And then you can literally build it over time. So that's the way that I think about like getting something like discipline underway. A great example could be, again, going back and instead of saying, I'm going to read about trading or investing an hour a week, saying I'm going to do it for 5 minutes a day or 5 minutes every other day, right? You make the threshold so low so that you really don't have any excuse on planet Earth to miss it. And then more often than not, what you'll find is you'll actually do more than the thing because you're already there. You kind of started the process. You got over that initial friction and you're into it. So that's how I would start there. The one thing I would definitely encourage people to keep in mind with respect to discipline is that it is super easy for it to fade away. So it's unfortunately not something that once you do it, it's kind of there and it's always going to be there. It is something you have to like continually reinforce and perform. Otherwise, your body is always going to try to take the easy way out. This is why when you're, trying to do something challenging, some people will procrastinate. Sometimes people will try to find a different reason to not do something, right? Like there's a million different versions of this, but the main point is it's not something that you're going to build and then it's just always going to be there no matter what. You do have to keep on top of it. The cool part is once it does become more ingrained, it does become way easier overall to actually like execute discipline. So that's that. Humbleness. I already gave literally the entire cheat code for this for your first 5 years of trading. For your first 5 years of trading, you literally just say, anything that I look at that looks good, I don't trust from my own analysis, and I don't think this is actually there. I'm going to try to do a little bit of homework on it first before I do anything. And again, this is a great time to tap into either if you have a little presence on social media, if you have other friends that trade. If not, as always, right? Join our community. I already said it's free to join. But it is good to get a second set of eyes. If you can't sort it out on your own, use ChatGPT. That's another route you can go. But literally just don't trust anything that you're doing. That's your easiest course of action in the beginning, because the probability of you missing something or making a mistake is astra-fucking-nomically high, especially, sorry for Chris and for the kids, my bad. I take that back. Take backsies. Didn't mean it. Is astronomically high, and there's a cost associated with it that, again, a lot of people when they're first starting can't bear it out. So that is my TED Talk on fixing some of these common behaviors. So what I would love to do now is double click into any of these that are of particular interest to you. And then for TCM, I'm actually really, really interested in your kids, because I really think that there's a couple things that might be useful for them to know. TCM says all good. They are taught. Some people use bad words. It's just a part of life. Yeah, I think that that's a great way. But nonetheless, it is kind of like a switch for me that I'm able to generally flip on and off if I make the choice. So I can absolutely make the choice out of respect for them. Now, I think for them, the thing that I find super curious is, like, my guess is they don't likely understand the value of money and time yet. And I think it's not until you really grasp those points where investing or trading or really just some sort of return on your money becomes really interesting. Because once you do understand that relationship, then the idea of investing becomes super cool, right? The idea that, like, you don't have to work at a job your whole life, because the reality is for most people, they're going to work at a job that they don't like. I feel like for a lot of younger, like, kids, when we're growing up, we're thinking that we're just going to work in really cool jobs that we like. I think originally I was planning on being a cop or something, because I think it's, like, really cool to help your community. I was super passionate about it. And then I start to realize, like, how much people hate cops, and then also how terribly they're paid. And then I was like, I mean, it looks cool, but I literally would be better off just making a bunch of money and then volunteering when I feel like it, like that kind of thing. So specifically for your kids, TCM, I guess the thing that I would try to keep in mind for them, and I don't know how well it'll connect based on, where they're at and like their worldview, but I obviously, for most people, know that like I did not grow up really with much money at all. I had a single parent that struggled, like literally struggled to pay the bills. I distinctly remember answering the phone for debt collectors. We would answer the phone, my brother and I, because they wouldn't like press us as kids. So that was like a purposeful thing that was done. And that I'm not like scarred for it. I would do it again, no problem. But that's just where we were at. And the only reason why I've been able to like meaningfully change my circumstance as early as I have, I know that I look like I'm 60. That's just because one of the beautiful things about being a white dude is we age like milk. Just kind of how it goes. You got to accept some aspects of life. That's one of them. And even in my late 20s, I found myself at a completely different financial spot than the overwhelming majority of my friends. The overwhelming majority of my friends were struggling to buy their first house. They're struggling to take out a loan to buy a car, which is always a terrible choice. And I was at a completely different spot simply because a high school teacher introduced me to the topic of investing. I took that to the extreme. It's kind of how my personality goes. And I got into trading to try to like really speed stuff up. But it's because of that dude that by the time I was in my late 20s, I was in a completely different spot than the overwhelming majority of people that existed. So the really cool thing that you guys have in front of you, because your dad is trying to put this stuff in front of you, is if you do start this stuff earlier, it has a profound impact on your life much earlier. And I know that doesn't mean anything right now. It's something that maybe you can try to, revisit in some time. But this is one of those things where I just hope you trust what your dad is saying. And I hope that you can just execute the steps, even though the steps won't mean a whole lot in the front. Trust both of us. They will be worth a lot later, and you'll be super, 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 super thankful that you did it, without a doubt. TCM says, trying to teach them money comes from work. They struggle with the savings part, although the 12-year-old does with setting a goal, savings, does setting a goal of saving for an expensive item. Yeah, that's good. I think that's really, really good. And I think that's a really good lesson, because the reality is for most people, they spend the majority of their life exchanging their time for money. And the point of investing is to stop that cycle. And it's to enable you to exchange your time for things that you value spending your time on. So the sooner you can get to that point, I think obviously the light years better off you are. Because the game of trading time for money is a vicious, vicious cycle. And I spent time in Deloitte in consulting, right, to learn about the corporate world when I was transitioning out of the Marine Corps. And I learned a lot about how businesses do things. Businesses do things in a super smart way. What I mean by that is, let's take a look at the earnings for a couple CEOs from some of the larger companies. Let me get rid of this thing. And let's just see. So let's do CEO earnings for S&P 500 companies. All right. So let's see. This is what a CEO makes across various S&P 500 companies. This is telling me that it's $18.9 million. Let's just do some back of the napkin math. So let's ask another question. I'm just going to do these through ChatGPT because it'll be a little bit faster. I'm going to say, what is the average number of employees at a Fortune 500 company? $62,000 personnel. So let's do some math. We have 62,000 personnel, and we have $18.9 million. That's just what's going to the CEO. If we just take a look at what the average earning is, what is the average earning for one of those workers? Let's see how much they tend to make. This is for one person CEO. So it's about 112 per year. This right now is not to take some sort of massive stab at CEOs. That's really not. This is more to provide context on how much the average person makes over different time frames. So let's just see how long it would take the average person to make that 18.9 million. It would take them 168.75 years. It's going to take a hot fucking minute. Oh, sorry. It's going to take a hot minute. So because of this, this is why investing is super, super, super important. Super important. Because unless you want to be one of these people that live the very standard average life, and I don't say that in like the worst context. Average is just the reality for most people. But if we look at what that actually means for people, it looks more like this. So what I'm ideally showing you here is that the average person essentially retires at 61 and they live until 77. So what that means is the average person spends about 45 hours per week, every single week, from the age of 18 to 21, again, depending on, or 22, I guess, depending on what time you start, until they're 61. Doing that thing for however many years you end up working. A lot of people are working later than 61 now. And then after that, you already are on the downslope of your health span. So there's a difference between lifespan, health span. Lifespan is obviously how long you live. Health span is how long you live a decently viable life, right? There's a ton of, my mentor's a great example of this. He had worked for a ton of time, and then he had some pretty good ideas about like what he wanted to do in retirement and those kinds of things. And then what ended up happening is he had the stroke I told you guys about. He's been dealing with cancer of different kinds. So like stuff happened. So it's not like that person made the retirement and then they were just able to like go gallivant around and do everything. Like the person's now just dealing with a ton of medical stuff that's super, super challenging. So this is my argument for most people, that it makes way more sense to focus on stuff like this early enough so that you can affect this time frame, right? Like depending on how much you want to have in order to live, the way that I discuss this with people, especially like when we're creating roadmaps for coaching clients and stuff like that, is I give 2 targets. The first target I refer to as the minimal viable product, freedom number. The second target is the optimal target, what we would like to hit. So here's what that looks like in context. And you can literally do this for yourself. You can say, let's say on average, I don't know, maybe you guys put it in there for me so that we can figure out what this is. What would you guess your minimum monthly expenses would be? So that includes car insurance, gas, cell phone bills, groceries, utilities, housing costs, whatever that is. What would you guess the minimum monthly cost is? So when I say minimum monthly cost, to me, that's getting rid of, if you have a Netflix subscription, you don't need Netflix. That doesn't have to be there. So it's like stuff like that. My guess for most people, it's probably what? I literally don't even know. I'm going to ask ChatGPT. What is the average monthly expenses, average monthly total expenses for American? Because I literally have no idea. $66.40 per month. Cool. So let's say instead of, oh wow, you guys are like super low. Kirk says 3. Robert says 2,500. GC says 3. That's fascinating. So you guys are like way, way, way lower than at least what this seems to be telling me on average. So on average, housing is 16 to 21, transportation 7 to 1,100, food 832, insurance 796, healthcare 487, 513. Entertainment, 303. That's nuts. So let's call it like 6,500. And this will all be post-tax. So this is per month. This is what you need per year. We figure out what this looks like per month. Again, this is not including taxes, which if you include taxes on this, it's probably pretty close to this, if not less. So what I'm showing you here is that you will spend the majority of your time literally trying to make ends meet unless you find a smarter way to go about things. So even somebody that's making the average salary of 112, this is using a Fortune 500 company, which that's going to be more than most people make. So I'm already cherry picking on the high end for that example. You essentially are going to be struggling to hit this. So let's think about what somebody would need to do in order to be able to cover this minimum viable product. This is the MVP for your retirement. The reason why I call this the MVP is once you're able to successfully cover this amount with your activities, whatever that is, a mix between the different stuff that you do to make money. Once you're able to cover this, in my opinion, you should still work. But you now genuinely have choice. And working feels completely different when you have choice versus when you have no choice. The fascinating thing is I work way more now than I pretty much ever have. I work all the time. And it doesn't, I don't care because I have choice. Like I literally want to for different reasons. So the minimum viable product, though, this is the point at which when your boss tells you to do something that you might find morally ambiguous, you might just disagree with entirely. A great example for this is during COVID. There were a lot of jobs that were like, in order to still work here, you have to go get the vaccine. And I'm not, again, talking about it one way or the other. You have to do whatever's right for you. But the fact that that becomes a requirement, and a lot of people didn't like that as a mandated requirement for your job, that puts them in a terrible spot. Because if you're trying to provide this and what you make in your current job essentially barely gets you there, then doing that thing that the company's telling you to do, even though you would rather not, you kind of just do it. You don't have choice. So the minimal viable product is designed to give you that first threshold of choice, but we still want to build. So what I generally would do is start the scoping process from here. And then I would have like a target. So then the target essentially would be, what is a really awesome lifestyle that you would want to live that doesn't include stuff that's really over the top? So stuff like having a yacht or having a private jet. This is the stuff where the target becomes, what are the things that you would really want to be able to do? So for my wife and I, we don't cook a lot. We order out. We probably spend a few $1,000s every month in just ordering out. And between that and like having people cook for us, I actually like cooking, but it's just time consuming. So the point is, that's not something I would account for in the minimal viable product. In the minimal viable product, I can cook. It's completely fine. She can cook. It's fine, right? Like we can cook for ourselves and save a bunch of money. But in the target scenario, if we want that as a choice, then it gets included in terms of the total inflation to the budget. So if we start at $6,500 and then we want to add the ability to essentially eat whatever we want, whenever we want. So we add $3,000 a month for two of us. Then let's say on top of that, we want to be able to travel 5 times a year. On average, it costs however many dollars for you. Right? Like we go through that exercise to figure out what this grows into based on what your target is. So let's say your target becomes maybe on average $15,000 a month. I'm trying to scale this for like most people, I would say. So now we're at 180. So your job in the investing world is to figure out, how do you cover these numbers? How do I first get to $6,500 a month reliably? And then how do I get to 15 or whatever that number ends up being? This number can grow as you hit your target and then slowly move your target up. But I think that there's a really delicate balance between the stoic practice of like being satisfied with what you have, being appreciative and not aspiring for a ton of stuff beyond what you have, versus, and when I say stuff, I don't just mean material things. I mean like the ability to travel more, like that kind of stuff. I think that there's a delicate balance between aspiring for more and reaching out for more and growing for more, while being really happy and thankful with what you have and being content. But this here essentially becomes the trading process in a nutshell. What we need to do is solve for these problems. So then we can say, what's a way for us to get to $6,500? Well, let's say that we have $1 million that we've saved up, that we've built up over time. We can do the math and we can figure out what kind of return we have to get in order to get to this number. So if we start around a 6.5% return, the reason why I did that is I just dropping this in as a logical starting point for people. That actually gets us pretty close, and very frequently it will, to what you will end up needing. So if you have $1 million, you make 6.5%, you get 65K. Again, this is all pre-tax. You have to pay attention to taxes and the tax footprint, but that gets you close, but you still need more. And you need enough in order to account for your taxes and all that stuff. So then if we go to 8%, that gives us 80K. The problem with this is, although it's higher, it's still not going to compensate for taxes, your tax footprint, all that kind of stuff, which you have to plan for. So then you have to figure out how you want to get to this number. And again, for those that know me, you guys know that I diversify across a bunch of things. Trading is what I did to really build my initial layer of wealth. And then from there, I branch out into other things to create robustness in the system. And so that there's enough different sources so that it's never really that constrained. Kirk says part of the portfolio strategy can be tax loss harvesting. I hate that. I couldn't disagree more. Tax loss harvesting is like such a busted idea. That's like a way to cope with losing trades. Like, I hate the idea of tax loss harvesting. It's like, the way I view tax loss harvesting is that should be done continually all the time by managing your trades. Whenever it's time to take down a trade that's not working, you've just tax loss harvest, which is Spanish for taking a losing trade. I would rather have zero tax loss harvesting. I would rather have none of it, meaning every single trade that I put on makes money. That's my ideal scenario. Obviously completely unrealistic, but I absolutely would not include that as like part of a actual strategy, like tax loss harvesting specifically for that reason. Rational says, watching on delay, I'm basically the guy you're talking about with CSP and covered calls. Can you explain why it's wrong/deficient with adding options into buy and hold strategy, cash secured put, and covered call? I'm not trying to trade against option pros, just willing to give up a bit of upside for gains. I have way too many kids to be learning deep option strategy. Yeah, so in that context for you, Rational, you're kind of in a weird spot, right? Because the reality is, in most instances, you're going to underperform with covered calls. You would be better off just buying and holding good stocks that are growing. So the thing that I was referring to earlier, though, is that people will see those kinds of structures and then they'll think that there's some sort of edge built into it, which there's not. So again, like realistically, when you're selling cash secured puts and covered calls, you're actually going to underperform just buy and hold equivalent. So if the preference is, though, to do that for the sake of income and you don't want to, sell your holdings in order to get the income, that's okay. You could do that. But there's a cost associated with that. So the main point there is, if you right size fit what you're doing so that it makes sense, then that's completely cool. Not everybody is going to, take trading the direction that I take it. But with that specific example, it's just generally less productive than just buying and holding good stocks. You'd be better off in that scenario in the vast majority of instances, which is a good question. GC says, I live in Florida. It's cheaper here, likely. Yeah, definitely. I think there's a couple states like Florida that don't actually charge state tax. Now, again, it's a kind of tricky because a lot of times they'll have higher property taxes and stuff like that. But I live in California, so you guys know what that's like. I think we're number 1 or number 2. So we're at the other end of the spectrum. Any questions? Anything that you guys want to go over with respect to what we discussed, what we covered? My position on this is I think that in order to develop a viable approach to trading options really is not that complicated. It's really not that complicated. But it does require taking some time to sit down, plan things out, and then to iterate on that process over time. And it's just that most people aren't willing to do that. And again, fortunately or unfortunately, depending on how you look at it, it's unfortunate for them, but it's fortunate for the broader majority of people that do take this a little bit more seriously, is that's why there's an opportunity, is because it's not entirely priced out, because most people don't do that. So it does give a place to go. Lauren says, I have a dumb question. Let us know what the dumb question is. We will evaluate how dumb the question is. And if it's dumb, we'll just call a spade a spade. But if it's not dumb, we'll still tell you it's not dumb. Market today was super interesting with the sell-off. We talked about that actually quite a lot. Lauren says, do bid-ask spreads sometimes go wonky at the end of the month or some months? Could you explain a little bit more what you mean by wonky? For those that are unfamiliar with what she's talking about, she's asking bid-ask spread either for the underlying itself or then for the individual options within a chain. So there's a couple things that directly impact bid-ask spreads. The way to look at a bid-ask spread is it's kind of like a liquidity measure. It tells us how tight a market is between, again, two sides of a potential trade. So there's a few things that directly impact the bid-ask spread. The first thing is what kind of liquidity provision is there. So that's why a lot of times you'll see names like SPY, one of the most liquid names that exists, will have a bunch of different expirations. It'll generally have a bunch of volume and open interest across the different expirations. And then you'll generally see tighter bid-ask spreads, so the difference between the bid and the ask. Now, there are conditions that lead to this spread widening. Lauren says there was a wide bid-ask spread for many of the stocks I was looking at yesterday and today. Not sure if it was specific stocks, but it was quite a few. Yeah. So what you're experiencing there, Lauren, actually, this is a great example of identifying a trend, but then not matching the correct feature. So that trend you were picking up on actually has way less to do with the end of the month. There's really nothing special necessarily about the end of the month for that specific question. But it has everything to do with volatility. So as volatility expands, the market will get wider and wider. So the reason for that is that serves as kind of like a natural buffer to price. And the market makers then demand a premium in order to continue managing risk and to then be thus compensated for the risk that they're taking. So they'll widen out the markets. So yeah, that's one of the primary reasons why you'll see bid-ask spreads widen out, is due to volatility. Now, you'll also see them widen out if for some reason we do not want, we being just the proverbial market makers the other side of the trade, that they don't want to transact there for some reason. So a lot of times what you'll see is it's not just the bid ask that matters. That's a really common rookie mistake. It's also the size, because you can have a really tight bid ask spread, but no size behind it. So that means that you can't even put on a trade before it moves, right? You might only be able to get on a one lot or something before it actually will slide off. So market makers will also adjust their bid-ask spread, and then also what they're willing, their size, what they're willing to trade at that bid-ask spread based on what they're trying to do with their book. So if they're trying to slow down something, they're going to widen out the spreads, and then they're also going to offer less at those prices and then adjust more so the bid-ask spread as they get filled on those sizes. So yeah, no, that's not a dumb question at all. The short answer to it, though, is that literally is just an artifact of volatility more often than not. There's definitely other factors that will bleed into it. But a lot of the names that you probably trade, the slightly more aggressive, I don't want to call them meme stock, but higher vol names and stuff. Those are the kind of things that will have pretty wide spreads. All right, gang. That's all I got for this Friday. So awesome hanging out. Hopefully gave you a couple ideas, a few things to think about. We definitely talked about a lot of different strategies to create a very healthy starting point for trading options, which is what we love. That's what we're here for on the Friday series. If you need anything, let us know. Be an outlier. See you guys later.